Today we'll be asking, why are equities so resilient? Good morning and welcome to Morning Markets. So far, the shock to equities from reciprocal tariffs has been dramatic but quite short-lived. Non-US equities have almost recovered to their March peak, and US equities have almost recouped their post-Liberation Day losses. That leaves US equities down about 6% year to date, but European equities are up by about the same amount. The question now is, where do we go from here? Analysts are downgrading their expectations for earnings this year at a dramatic pace. However, expectations for earnings in subsequent years remain quite high. Perhaps analysts are expecting significant rollback of tariffs and likely tax cuts to offset the detrimental effect on earnings of heightened uncertainty. One lesson from the pandemic is that equity investors are prepared to look through a drop in earnings if they can see a subsequent rebound. However, there are important differences between then and now. The pandemic was an external shock that was met with unprecedented monetary and fiscal stimulus that more than offset the impact of the pandemic on household incomes and corporate profits. By contrast, the current trade wars are self-inflicted and unlikely to be offset by outsized policy stimulus. Falling inflation does give central banks in Europe a green light to cut interest rates, and fiscal policy stimulus is likely in both Europe and China, but policy stimulus on the scale of the pandemic is unlikely. The bull case for equities, then, rests on hopes that Trump is sufficiently scolded by the immediate market reaction to his reciprocal tariffs and has no option but to capitulate. Thank you for listening.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.